Hi there, welcome to this weekend general update for the 14th of October, and a little bit of downside in global markets over the last couple of days, but I think that's just part of the mild correction that we really had to expect during October, given the run that we've had since late July, and the signs still looking extremely positive from now into the end of the year and into the early part of 2013 at least. Now, general advice only, just a quick reminder on that. Now, a summary of the week, the S&P index was lower by 32 points, so a fairly sharp move on the week, but really pretty much what you would expect in my view. So it's what I'd call a healthy retracement. If the market just kept going up and up and up, then eventually we get a more significant correction. So I think this will just clear some of the excess out of the market. Looking at 1420 as a support level, the market finished about 6 or 7 points above that on Friday night, and if that level doesn't hold, then 1395 would probably be the next level, but I reckon that would see it out. Now, the ASX 200 ended up lower by 8 points on the week with a very narrow range, so the Australian market continues to outperform most of the other global markets at the moment, which is something we've not been able to say for quite a long time. The defensive stocks, banks, telecom, healthcare, still remain the outperformers, but we'll have a look at all of those sectors on the one chart, and I think we're on the cusp of maybe seeing the underperformers, which has been energy and materials, starting to see those make a bit of a comeback. Now, the US dollar, importantly, the currencies are always what's driving the markets. We could now be in a consolidation period. It's a bit hard to tell in the short term, but to me the main trend is still strongly lower. Nothing has changed, and frankly the US government wants it that way. They're not publicly saying that, but you've got to look at their actions rather than their words, and clearly they want to devalue the US dollar and improve their export position and inflate away their debts. Now, bond yields also showed improvement. The Spanish 10-year was down to 5.62. It wasn't that long ago that it was above 7. And the Italian yield was down under 5% for the first time in a long, long time. So certainly some encouragement there from the European bond yields. So we'll start with the US dollar, and you can see we had a sharp move down. We got overbought. You look at the RSI, significantly overbought. We got a bounce to almost back to the 50% retracement of this short-term move, the one that started late August. Started to roll over again in early October, and then we got a little bit of a bounce, and now we might just get some sideways consolidation. But I see nothing to suggest that this is anything other than just a pause in an ongoing downtrend. Now, looking at the S&P index, just pan back and have a look at the big picture. We've got resistance up there at 1520, and then again about 1565, 1570. Now, we've had a terrific run since the market turned around on the 4th of June. You can see very, very strong rise. Now, we are now into a consolidation because for the first time we've now got a slightly lower high and we've now got a lower low. So there is a trend change on. So the question is this a short-term trend change or a more significant one? Just looking at the pattern, to me it's short-term only because the way that this first leg here from early September, so this leg from here to here, if you look at the range of the days, that there wasn't a lot of huge selling. It went sideways for quite a period of time. We only got a couple of days down and it didn't go very far. We then got a run back up to a high that almost equaled the previous peak, so that's indicating strength. And now in this run down here, again, there's no really significant down days. It's just been, mild controlled selling to my eye. Now there's some support here around about this 1420 mark, which corresponds with these peaks back here in May. Or we've got the first Fibonacci level around about 38.2%, and that comes in at 1395. So to me, they're the two likely support areas on the S&P. But look, it all looks pretty mild to me, so I just think this is a good thing. The RSI is unwinding, and if we can get another week to the downside with fairly small range days, bottoming out somewhere between 1395 and 1420, the RSI will be oversold, and that'll just set up then, I think, a really good run into Christmas. So I'm not too concerned about that. In fact, I think it's a good thing. Let's have a look at the VIX index. This is the VXO, and we're still down. We're in the 15s, which is still by historical standards quite low. So there's certainly no real concern in the market to go with the fact that the price is easing back a little bit. Now the ASX 200 has really been performing quite well comparatively since early September. So it's outperformed a lot of global stock markets over the last couple of months or so. Now if we have a look at a relative strength chart or relative comparison chart for the Australian indices, let me just find the right one. This is the one that I want. So I've been showing this one over the last couple of weeks. The ASX 200 is this green one here in the middle. There are 4 of the sector indices that have outperformed it over the last year, and particularly since around about June. And there are 3 indices that have underperformed it. So the underperformers have been materials, energy, and the yellow one there, which is very difficult to see, but that's the Small Ordinaries Index. So that's the small cap stocks. The outperformers, we've got finance, information technology, which includes stocks like Computershare. Then we've got telecoms, and finally at the top we've got healthcare has been outperforming them all, and especially in the last month or two. So that just gives you a sense of where the money is going in Australia. It's still very much towards the defensives. We've got energy and materials starting to make a bit of a comeback, even on a relative basis, so there's a little bit of improvement there. But at the moment, a lot of the money is still flowing towards the defensive side of things. Now, turning to gold, declined by $28 on the week, and again, this is pretty healthy. It was overbought. It needed to pull back, otherwise we end up with a bigger correction. So 1720 is the likely support area that I'm looking at. And we also saw silver decline as well. And on a bigger picture level, expecting silver to outperform gold over the next 3 months, 6 months, possibly a couple of years. It generally does, and I would expect that to happen again this time. Now turning to copper, it eased back a fraction. It's been holding in this $3.70 a pound to $3.80 a pound for quite some time. Just eased back a fraction last week, but nothing much in that. And oil ended up rising $2 on the week after being smacked the week before. This is the spot copper chart. You can see it's just eased back a little bit, but still not that far off all-time highs. Now let's have a look at gold and silver itself. So we'll look at silver first of all, and then we'll get to the gold charts. So this is silver. You can see we've had a consolidation here that really started in early September, so it's been going now for about 4 weeks. It really had got quite overbought, so it's just unwinding that, and it's doing it in a fairly controlled way. If we put a retracement scale on that, then somewhere around about the 32.20 mark would make sense. So we might see another $1.30 come out of silver yet. That would have the RSI down to oversold, and that would be, I think, an outstanding entry point for silver. Now looking at gold, this is gold on a weekly chart, so you can see we spent 3 weeks at that resistance level. We're now starting to pull back a little bit, and if we go to the daily chart, I'm looking for this to come back to around about this 1717, let's call it 1720. That would be the area that I'd be looking for it to come back and consolidate, and again the daily RSI would then be at an oversold level, and that would be a very good entry point. Now turning to the gold stock indices in the States, this is the HUI index, which is the main one. It had also become overbought, so it's unwinding now, which is a good thing, but still looking pretty strong. And let's have a look at some relative comparisons again. This is silver versus gold over the last 12 months. Now you can see that the blue line is silver and the green one is gold. You can see silver had been underperforming gold since around about April, significantly underperforming. The peak of the underperformance occurred around about late June. There was then a very wide performance gap between silver and gold for quite some time, and then as this gap narrows, that means that silver percentage-wise is rising faster than gold, and in actual fact got back above it on a yearly basis. Now the two of them have come together, so looking at it over the last 12 months, gold and silver have performed identically, but if you look at the last few months since early August, then silver has outperformed gold quite considerably if we just looked at that time frame. So I think that relationship is starting to, that outperformance is starting to accelerate, and we could see silver going up at 2, 3 or even 4 times the percentage rate of gold over the next 6 months or so. So I really am very bullish on silver. And the other chart that I want to look at is sorry, just let me find the right chart. Okay, this is gold in the green on the top. That's US dollar pricing gold, and underneath that we've got the HUI index. So again, you can see stocks had been underperforming gold by a very large margin. We got an extreme in mid-May, we got another extreme in July, and since July stocks have now been outperforming gold, because you can see here these lines are getting closer together. So the stocks have been doing better than gold, and I would expect that trend to also continue as well. And we've certainly seen some extremely good moves amongst Australian gold producers, probably some of the best performers anywhere in the world from what I've seen. Now, just quickly looking at the strategy side of things, again, look, nothing's changed. Pretty consistent. We're looking to buy the dips. This retracement should yield up some better opportunities, I believe. A lot of the stocks that we've been looking at have been overbought for some time, not really giving us good entry opportunities. Ideally looking to buy oversold on a daily chart, and really that's the same strategy that we've been looking at now for the last couple of months. So that's it for this update. Talk to you next weekend. Cheers.